Hey everyone, this is DayTraderRockStar, and this is the market radar for the week of February 9th. And we're also going to do some reviews of stocks we traded this week at Day Trading Radio. And we're just going to kick off here, just taking on a bird's eye view of the S&P 500. We know we've tracked this stocks every single day. We kind of analyze it. We base a lot of the bigger trends on this. Everything seems to be pretty much a healthy chart here. You had this rising wedge pattern. You had the breakdown. You came down to a 1, 2, 3 pattern. You had a retracement back up to the trend line. You had the pullback. It held support. It actually gave us a divergence, which is we dropped a little bit lower. Stochastics turned back up, and then from that point on, we got a nice move up. So this is textbook DTR type of material we go over every week, and seeing the signals, understanding the bigger trend, helps us decide what direction of the market we want to go. The tide is always helps the ships. So either if the tide's going out, the ships are going to go out. The tide's coming in, the ships are going to be easier to go in. And I also use this as an analogy to wind in your sail. When it comes to the stochastics, the wind in your sail, the momentum, one of the greatest indicators out there. And as you can see, we're starting to get overbought here. So now being overbought, that means something to us. We had a little reversal today. We closed down on the day, but we started off a little bit higher, which is typical. We actually went into a few stocks that look like a flag breakout. This could be considered a little flag. You get that first day, and lots of times that second day we kind of pull back. And a great example I just want to talk about, because this was a fantastic flag that we traded this week. Got in recognizing that flag into this candle, saying we're going to get a follow through. We're going to hold into that follow through and look for a follow through of that follow through day out of that breakout. Usually these type of flags, you get a couple days and then you get a shake. And I always say that on that second day, you get what you're doing is usually get a little retracement, and then it turns around and takes out the previous day's high, which you can see right here. And then at that point, you're going to sell into strength there. You're going to sell into strength, and at some point, usually we start to see the market sell off after that. And that's exactly what happened. If we take a look at that 5-minute chart, it was just really a textbook. Here's your flag. Here's your first early morning pullback. We took off. We actually took this off at 120.58. It did move up a little bit higher, went up to 121 and change. But that was a great trade anyway. It was for $3.50. So, but you can see you don't want to just continue to hold on to something, because you would have ended up down here at the end of the day. So it's very important to understand each individual pattern, what the patterns mean, and how they react with each other. Now let's get back to the S&P cash chart, because I think part of the market radar is what we're going to look at. And you're seeing a lot of when you see a trend, you see the good up bars, and then you see a lot of red bars on a little downward trend. And these are usually most of the time in line with this momentum. The stochastics here drifting lower, the price is drifting lower. The stochastics are pointed up and moving higher, the price is moving higher. Times we have that change up, and we see that does not work out. The divergence isn't something to pay attention to. But right now we're kind of pushed up here back into an overbought level. The possibility of this rolling back over is there. The daily here is giving us a little topping pattern. We had a little candle that kind of came back down, took out the highs, and kind of closed near the lows of the session. Not quite at the lows, but we had a little bounce at the end of the day. And the big thing here is that 60-minute time frame. Because when we start to look at some of these stocks, and I'll give an example of Johnson & Johnson here. If we take a look at Johnson & Johnson on the daily chart, man, it's crazy, right? That's an example, yeah. You're seeing a lot of chop here, a lot of chop on the daily. The trend seems to be down, but one day is up, next day's down. One day is up, next day's down, popping back up, down, up, down, up. If you're trying to trade this for a swing trade, it could get annoying, because you're really chopping around. And that's, if you could accept that and you're a long-term investor, that's fine. To take a look at the bigger pattern, we understand what that pattern means. We understand where we want to get in on these patterns and where we want to get out. But once you start to chop around here, you have to understand that it's very hard to just maintain that. So what we want to do is start focusing on that 60-minute time frame. And there's a big difference when you look at the 60-minute now, because you could actually see there's really just, even on the move down, you get oversold, you see a nice move up to overbought, nice move down. It becomes a faster trade, yet it becomes a more directional trade, and you actually could really pinpoint overbought, turn it over to oversold, downward move, oversold, moving up to overbought, slight little pullback. Sometimes you get a cross back up on a strong market, but overall you're pretty much looking at a reversal or a change of trend once you start to get to those extreme levels. And then when you add the other indicators, then you could actually add that up. I mean, there could be support lines here, which is right there. We started to get a little bounce at the end of the day. And that's what we're going to do. We're going to continue to do that. So get back to the S&P here. We're going to be concentrating more on that 60-minute time frame, which has started to turn over today. We started turning back over. The last time we were oversold, we actually had that divergence, that lane divergence on the daily, and we had that support line and we were oversold. And that's where we're looking for that move up. Now we've gotten the move up, kind of embedded up here, showing strength. But we also knew that was a ticking time bomb. I called it the musical chairs. That we were up here for a while, for a few days now, and it doesn't stay up there forever. We usually stay up there before we actually rotate back down. And when we rotate back down, it could be a pretty severe pullback. So we were rotating down there, and yesterday I said, well, we're up here on the 60, so it's kind of like a game of musical chairs. The chairs are disappearing. The music's still playing. We're still pushing higher. But at any point, the music could stop, and we could actually rotate back down. And that possibly could be happening on a Friday. We had the jobs report today. It was good. Market took off. And then we had some comments coming out of Fed Lockhart. And that kind of, didn't really sell off the market that hard, but it did give us a little vacuum areas where we dropped off. And just kind of, was out there. So it was kind of a choppy day on a Friday. It's not my favorite day to trade. We did get a couple trades in. And but I'm looking forward to next week. So right now, with that 60-minute here rotated back down, the daily here kind of extended. We still have some targets above us. We take a look at the big picture here. We're not that far off the recent highs. The recent highs right up here at 2096, close to actually 2100. Let me get rid of that. And but we're not there yet, and it doesn't mean that we are not going to get up there. We can actually correct on the 60-minute time frame. So we need a little more data here. We need to see if this is going to correct back up. If we do, that's a great sign of strength, or we're going to rotate back down. We have a trend line retracement we could be watching. We have other levels. We have the divergence we could be watching and some other things. So I would have to say they're slightly bearish for a little pullback just based on the multiple time frames. But I'm not putting too much into it. I think this week is on the watch list, which will come up next. I will point out some interesting shorts, and I already did start one short position this week. So I'm going to be looking at maybe a couple other short positions, and but not. We'll keep it nice and easy this going into next week. A little more cautious outlook going into next week, but just because we're looking at that daily kind of extended. This could embed itself. This could stay strong. That 60 could actually push back up. It feels strong, but we are starting to see that little weakness. So I'm kind of cautious. Could see some more. How fast do we get down here, or do we turn back up? If we turn back up, cross back up here, then I'm sure this will stay embedded, and we have a good shot of actually taking out the highs, all-time highs, and that would be something to see here right around the corner. All right, so that's about where we are on that. Let's take a look at a few stocks that we traded this week and kind of show you on individual stocks how we work here at DTR and the high probability methodology. It's very methodical. You develop patience and discipline. You take only the greatest setups. We take them in our favor with a lot of risk already taken out of the trade. Quality names that pull back to multiple areas of interest or trend lines connecting and combining different indicators. And we usually see those as great levels. And also understanding where to take them off. And we take it off and we move on. And we're building that account up. We continue to build up. We have been having a great month so far. So I'm not going to, not let anything stop us. It's been a great 2 weeks. Well, going on the second week, I guess. We're not even into the second week. It's a great 1 week. Jesus, I didn't realize it's only 1 week, and we've been really kicking butt here. All right, so let's take a look at some of the trades from this week, and then we'll get to the watch list. We'll start again with Celogene. Textbook flag. Flags have been very strong in this market. Again, I always like to recognize a flag, how a flag sets up. We could do that on once you start to see that flag set up, you can break it down in a 60-minute time frame and get a better entry. Flag is typically a channel, and the channel is divided or composed of multiple pivots and make a parallel trend line. And if you can identify the range here, it doesn't have to be exact, but just get a feel of where you're looking at. We kind of spiked down here. We had a nice 60-minute candlestick, and we're oversold. So a lot of those things. And at this point, we actually had a big daily candle. So that candle right there came into play, and that's the one that I was keying off on. So that's the one we bought into. And from that point on, we got a nice pop, and I said, hold on, because we normally see that second day pop, and then we see a sell-off or kind of a reconsolidation. So it worked out perfectly. But that's just a trick of the trade. And I would just, mark that down. If you see a good flag and you get that breakout of the flag, try not to chase a breakout like, wow, we're breaking out of a flag. Because what happens is usually that second, not in all cases, but in this market environment where there's traders out there, they're attacking these stocks at points where you could actually see some profits because you're already getting a move. You're not getting a move from this breakout and say, oh, it's just starting to break out. The move actually happened back here at 112. It went up to 120, 121. That's a 9-point move, and I would take profits on it too. I would see a pullback here. Don't realize it. Don't look at it as a difference, anything other than, be sure you get in on the best position, understand how a pattern works, and then move on and then continue to take the next setup. Now, you don't have to worry about finding the setups because I have the greatest setups here. I do so many scans on Friday, and we get out the best watch list. So you're going to see a lot more of these great setups. But just remember, it's important to establish that discipline, to take those profits into strength, to buy the quality stocks into weakness. You'll never buy the bottom unless you buy the fear or buy the weakness, and you'll never sell the top unless you sell into strength. All right, or you sell to greed. That's just a simple fact, and most people think, the opposite. They're afraid of a stock that's going down. And a good example of this was a stock that we got into, and I consider one of the best bets going into next week is Discovery. Discovery, we labeled it as a lane divergence. We made a new low. We started, building a position. I'm already up to about 300 shares now. And, it's just off of this base, the lane divergence. And yesterday we saw some selling in it, but again, I wasn't too impressed with that selling. And today we basically grabbed that all back. And we're set up for going into next week. We did sell off with the market at the end of the day, but we are definitely set up next week to see if we get a pop and, get back through that 30, 45, 30, 50 area. Really will get this one going. So that would be something I'll be watching next week. That'll be on this week's watch list, so we'll look for that also. I'll give you the targets to look for. All right, one thing I want you to look at is the stocks that we've been trading this first week. This actually goes back into the beginning of January too, but the first week here, the first probably 7 stocks. There's a certain thing that you're going to notice about these stocks. All of these are quality names: the Celgene, the Kohl's, the Disney, the First Solar, the DirecTV, IDTI, HP, Tractor Supply, Amazon. There's no penny stocks. There's no crap stocks out here. It's very important to kind of stay on that path. You know what? The more you go away from that path, the more you go into that path of gambling. Gambling on things. Yeah, there's going to be opportunities out there on penny stocks and stuff, and if that's your game, well, that's fine. But understand that here we try to, we have such a good methodology that it works great on quality names. It's just because there's so much interest in them. We know the technical levels. We know the combination of things that we look for, and we know, and this is the results. This doesn't happen unless you're picking the right spots. We do it live each and every day. And if it wasn't going to work out, these would be red. Yeah, there's some red out there. Joy effing Global there. My worst, I see a great pattern on that. It's actually working out good now, but I didn't have patience with it. And the SPXU was a hedge looking at a short, so that makes sense. We took a hedge on the market. The market continued to push up, and every so often I'll take a hedge in the market. So let's break some of these down. We talked about the Celgene. That was the flag. We just took that off today. Kohl's. Let's go to Kohl's. Kohl's we've been in and out of multiple times recently, so you'll see a lot of charts here on this. And again, very organized stock. Oversold, overbought, oversold. At this point, we had this recognizable channel. the oversold stochastics. It was just a combination of everything that we look for. That was probably one of our entries here. And then we got back in on a small pullback here after it popped and we took profits. We got back in, and then it continued to pop. And the reason we got back in was we flagged out, and whenever we have a nice strong stock that looks like it's going to take off, we look for that. We go down to that 60-minute time frame, and that 60. I think it was right here. What happened was we saw a lane divergence, which is my go-to indicator setup here, is where the lane divergence gives us that perfect opportunity with the rise in stochastic falling price. And we took that, and then from that point on, it was all history. And again, I will continue to find those lane divergences. This was on the 60-minute time frame, and when you have that 60-minute time frame, it happens so much faster. So that's the reason we got in it. You should always have a reason why you're getting into a stock. There should be a good reason. You should have a set of rules, and or playbook. What I call them playbook plays. And in DTR, let's just take a look at. There's so much here to go over here. Well, let's just continue on. Disney. That was a no-brainer. DIS continues to flag out. We track this one. Every time it flags out, it gets oversold. Flags out, oversold. Flags out, oversold. Before earnings, we took it off. It gapped up on earnings. We just took it off. I mean, there's some stocks that you just recognize that they're great stocks, and you just take the opportunity. You don't chase them, because of course this is moving up. You finally take out the highs. I try to express to this notion that we're taking out 52-week highs here. It doesn't mean that we're going to continue to move higher. And Disney, this is where you want to get in. Now, what's going to tell you to get in there? It's selling off. Everything's hitting the fan, and traders get fear. So you don't buy there. You end up buying on strength, and that's okay in some cases, but most of the cases. And it isn't okay, actually. I take that back, because the truth is, if the stock's going to go up, and I show you a chart, and I say, where would you rather be in? Would you rather be in here, or would you rather be in here? Looking back at it, you'd rather be in here. How do you time that? Well, you time it by looking at certain support levels, candlesticks, the stochastic momentum shifts, and then pattern recognition. And each one of these, where would you rather be in on the flag? Well, you want to be on the flag on the lower portion of this channel. If you break that on the 60-minute time frame, then you get the breakout, and then it pulls back. You get a breakout, it pulls back. So of course, every time it breaks out, it kind of ppulls back. So imagine you're getting in here. You say, "Oh, it just broke out of a flag. We're moving higher." Next thing you know, you're down 5 points, and you're selling it because you just don't know what's going on. Well, here it is, oversold, reversal candle, off to the races. Not much more I could say about that one. Let's continue on. Disney, FSOR, First Solar. Good setup. It was a wedge pattern. Wedge pattern is one of my 3 favorite patterns. That would be, the wedge pattern, the rising wedge or the falling wedge, a channel or a flag. All right, so we mentioned wedge patterns, channels, and flags. Channels and flags kind of go hand in hand. I wanted to show you a couple of examples of the wedge pattern. As you can see, First Solar, pretty decent wedge pattern. Let me move this over a bit. You can see the underlying trend line. Let's clean it up a little. Let's take this. Let's take that out there. And basically, you're looking at this downward channel. This downward channel here, conversing. You can see it bounced off. There was multiple trend lines here giving us the next marks the spot. We got a nice reaction off there. And basically, this is what we call the 65 to 75% area of the pattern. I go over this all the time on the show, but just in case someone else is new there, if you extended these 2 lines to a point, that would be 100% of the wedge pattern. So you kind of cut that in half, and then cut that in half. You get to that 75% area of the pattern. That's normally where you start to see that chart here break out, and that's usually a pretty decent bet there. Here's a couple other examples of the falling wedge pattern, just to give you some examples of what we're looking at. So this was just a typical trade based on a pattern, and there's also usually in a wedge pattern or a channel you see a divergence, and there was actually a slight divergence here. I think there was a a little higher low on the stochastics and a lower low on the price, and that happens a lot. So if I see a lane divergence and inside a wedge pattern, it's a combination that you do not want to pass up. You want to jump right in on that. And again, these are all based off of quality names and stuff. So the great trade, flags out now. It continues to look like it's moving higher, but we're done with that trade, and we'll move on to the next good setup here. So let's just kind of go back here. Disney, FSLR, DirecTV. DirecTV was a trade we did this week. We took it off. I mean, it was just it's just a channel trade basically, and it had a couple flags in it. So understanding channels, what happens with the channels? They break out and they pull back. So we saw that pullback. Understand the pullback was okay. I just was going to buy into it. Worked out great. Not much else to go into about that one. DirecTV, IDTI. Now this is an interesting one because it's a cheaper stock. Cheap stocks I tend to stay away, but it was your classic flag. And before, when we see a flag like that, a textbook flag, and this is what we call a kind of a flatline stochastic before it gets up to the overbought level. Whenever I see this as another kind of a technique that I've had over years of following the stochastics, is when I see them flatline underneath that 80 or 90 level and kind of flatline there, especially in a flag. What we're seeing is the flag has pulled back, the price has come back, the stochastics has really kind of just went sideways, and that means there's usually a good strong pop just to bring us back into overbought level. And as this flag was setting up, I put these arrows in saying that look for this to push through. And look where we just came up to. I mean, we did go right up to those arrows there, right up to the top, and we took profits into that pop on that. This is a good sign because when a stock like this kind of sets up, it tends to reflag out again. So an example that you're going to see, well, you might see on, if you remember, you're going to see it on the next this week's watch list. JNPR is Juniper Networks, and this is actually going to be another flag setup that we've been tracking here. So starting to break out here. Just another example. I'll go into more detail on that on the next video. But those flags are very important, and the channel. So getting back to a channel, the channels are just standard channels. A channel's just a multiple pivot areas, equal distance apart. You can really identify a channel on just using 3 pivot areas. The 2 pivot areas on top or 2 pivot areas on the bottom plus the third one. As long as you have that third one and that straight line on the top, you could easily make a parallel line. Then when the price comes down to that level, you're already ready for it. You don't have to go look back saying, well, it's not a channel. We haven't put another pivot in area. That's where a lot of people are not realizing. By the time it bounces up and you see that channel, the trade is already gone. You have to trust in the patterns. So you have to buy into that weakness. These are just examples that we trade. Even on the futures, same thing over and over again using stochastics and seeing how these things here continue. Some other patterns here. We won't go into these today, but if you have any questions, definitely email me. You can always email me at Iron Action. Well, make it DTRS. That's DTRS at DayTradingRadio.com. All right, so a couple other stocks that we've traded this over the past few days. All right, so that was the IDTI. HP, again, we're starting to, this is towards the end or beginning of the month. Well, this is the beginning of the week. HP is something that we've just crushed. And again, this is what we call a channel within a channel. You had a downward channel. We traded it here. When the next marks the spot, we got a bounce. We waited for it to come back down. It had a divergence, moved back up, and then we had a gap down. We bought it into the gap down and traded again. So it's just a good setup here. And we're not trading this now, but of course, each time we bought into that weakness, we saw the signals, and we buy the position. This still looks very good, but it's not an HPS type of zone. We don't have the stochastics in our favor anymore. And we could look back here. When you start to get overbought, you tend to move back. You oversold, you start to move up. So what are you seeing here? The potential of pulling back. The potential. The market get into a full bull, raging bullishness, and we could actually move higher on a lot of these stocks, and this could actually flatline. But that's not a signal that is going to get us into a position. It's just, you don't chase something up here. You don't guess that the market's going to rally at this point. We're going to get embedded. We know, the odds are once you get overbought, the market tends to pull back a little, and then we start to flag out, and then maybe break out. IDTI, that's a tractor supply company, TSCO. And again, this was a pullback here, I believe. It's end of January, and we took this off. It was just a nice pullback. Not much going on there either. 60-minute time frame gave us the dual stochastic. When we have the daily and 60 line up, that's a high probability setup. And that's how we do that one. So let's pause this for a second. Let me bring something else up for you. All right, here's the Joy Global, and with the Joy Global, you could see that was a perfect wedge within a wedge here. And this one kind of gapped down, and then it rallied. This one kind of shook me out. That was the one we actually took a loss on. And it ended up working out fine. I really did like it because of the lane divergence. Lane divergence was key on this. It was really a textbook great setup. And for some reason, I took it off because I was disappointed that it gapped down. But, that gap down really gave us that lane divergence, and it should have been bought. So, my bad on that one. Now, we could go into many other stocks and many other things, but I do this each and every day live at DayTraderRadio.com from 8 o'clock until 4 o'clock and every single day. So you can see we have our work cut out for us. Welcome you to come by. I also want to make the announcement we're actually launching a new product on Monday, the Tradeometer. You might have heard me mention it a few times. It's been an outstanding, this actually falls right into what we do with the high probability methodology. Because when we take a look at, let's come over here and take a look at how this methodology really starts off here. We talk about the 5 indicators. So we have the stochastics, and we have understanding that we want to be on top of the stochastics being the wind in our sail, but we also want to have the other indicators lining up. So we look for this, and we also look for what I call 2 or 3 or more of the indicators. Stochastics being one, then the price is on a confirmed trend line. It's on a moving average. Is there a recognizable pattern? We talked about the wedges, inverted head and shoulder. Well, the channels, the 1, 2, 3 patterns, the flags, support and resistance, and reversal candlesticks we didn't really go into. And it's an important thing to look at. So let's just go through a couple of these fast. And again, just to kind of give you what you will be seeing here on Day Trading Radio in the future. Let's just, I just want to go through, there's your price and confirmed trend line, a valid trend line. Again, I want to get to here's your wedge patterns, and everything here that we talk about has to line up, again, with the underlying, the stochastics and the pattern recognition. Plus, there's actually another wild card we're going to talk about, channels. The other wild card I like to call is the reversal candles. And the reversal candles, like a bullish, we're going to go into them a little bit more detail right now. We'll talk about the bullish engulfing candle. All right, this is where we kind of capture the previous day's body, trade underneath it, and close above it on the top part of the range. Very strong, and this has to happen at the same time that everything else is happening. So we get an oversold level, or maybe a recognizable pattern, and we see that candlestick play out. That is a key thing. And these 3 candlesticks, I only want you to worry about 3. An engulfing candle, a hammer, which basically looks like a hammer. And again, these all come at a point in the chart where you're either, and there's both sides of the story, there's shorts and longs. But in this case, we're just concentrating on the long side right now, just to give you examples. On the end of the thing, you have the oversold stochastic, you have the hammer. There might be something else there that you might be paying attention to. But any type of reversal candle is so important. Piercing patterns, again, the concept here is really taking out the previous low and then coming back and trading it back into the previous day's body. There's other ones out there, dojis and all kinds of things. But you put it all together and you start to see that things start to come together, and it keeps you in a disciplined, real state of mind, and that's what we do here at Day Trading Radio. So the new product, the Tradeometer, is really cool because it's going to actually add to the stochastics. What we're going to do, let me go back here fast. You know, where we see up here, the stochastics overbought and oversold. The Tradeometer here takes all the time frames, measures them out, and gives you a buy-sell signal. So then we're going to be using that as this indicator. So a Tradeometer setup works great. You know, if I could put a percentage, move on this outside of news and everything in a stable market, a normal market, you have to trade away from news, any events, stuff like that. You get rock solid alerts on that, and that combined with any of these other alerts, we're going to add a couple to it. Volume profile lines also. Just bring the percentage up so much. It's ridiculous, and it's just unstoppable. So please check that out. It's at tradeometer.com. We're going to launch it officially to the public. It's already available to Day Trading Radio members at a discounted price. But Monday, we're officially launching it. If you get your name in at tradeometer.com, that's TRADEOMETR, and you get your name in their email address, you'll get a discount. We're only offering a discount to a certain amount of people that sign up just for the official launch. And then from that point on, as you know, we lock you in, but the price will be rising in the future because it works really good. So feel free to check that out. All right, so that's the market radar. I hope you got some education out of this. You know what we're looking for going into next week. Now I want to stop this video. I'm going to start my new video, and this goes out to the members of Day Trading Radio. They're going to get the setups that are setting up. They're going to get the HPS zones that are setting up, the buy triggers and stuff, and it's all going to be at your disposal on the dashboard. So have a great weekend. I will talk to you Monday, and it looks like a great week lining up next week.